Are we there yet? The S&P now up by 0.3%. Want to ask Jordan Jackson, J.P. Morgan Asset Management Global Market Strategist. Jordan, are we there yet?
I don't think so. I think we might have another, call it 5 to 10%. You know, the reality is markets don't like uncertainty. There's a lot of monetary policy uncertainty. There'll be fiscal policy uncertainty as we move towards the elections coming in November. We still is a big question mark in terms of Russia, Ukraine, China with their zero COVID tolerance policy. So many questions, so many uncertainties out there. And one of the things I'm looking for that buyer to step back into this market. We haven't really seen, when you see this selling pressure, we haven't seen that buyer step back in from a retail investor perspective, from an institutional perspective. So I feel a little more confident when we see some of those buyers start to step back into this market. But with all these uncertainties out there, I'm not quite sure where we're there yet.
Okay, so at that point, if you see 5 to 10% more left, where can you still sell at this point? Like, are we going to be selling the winners here?
I think so. It's going to have to be some of that rebalancing. There's been a pretty big sell-off in a lot of pockets of the market. You think about the NASDAQ, the Russell 2000 growth. The average stock in these indices are down 40 to 50%, right? And so that means from a valuation standpoint, these are much more attractive entry points now than they were just 6 months ago. So I do think you sort of sell your winners, take profits there, sort of rebalance into some of the areas that have been hardest hit, and I think that'll pay dividends over the next 12 to 18 months.
Jordan, is the game here to make money or to not lose money?
I think the game here is not to lose money. Again, there's a lot of uncertainty out there. The price pressures will start to feel in different parts of the market more broadly. And so I think it's not just about owning the winners, but it's about not owning the losers as well.
Do you feel like the stagflation fear, so Bank of America had their fund manager survey out and said that the worries about stagflation are the highest since the financial crisis in 2008. Do you feel like there are certain sectors that have accurately priced that kind of stagflation risk? Or more to go, and which sectors might they be?
Not necessarily. I mean, we still see stagflation risk that's still relatively low here in the U.S. economy. Job growth remains strong. Consumer balance sheets remain robust. Even the negative first quarter GDP print, I think, really masks the still strong domestic demand that we have in the economy. And that's obviously contributing to some of the inflationary pressures that we're seeing. So we still think that it's a fairly low risk. And, you know, I'm not quite sure that markets sort of fully appreciate a bigger outsized risk of stagflation. I will say if we start to see job growth, payroll gains start to slow, maybe a tick up in some initial employment gains, if we start to see that those job vacancies numbers come down in the JOLTS report as well, that'll start to, I think, more bubbling concerns of stagflation, of course, if inflation continues to remain high. But I think we'll start to look at some of those data points to really firm up our outlook on if stagflation is really an elevated risk or not.
Jordan, if there's still downside in the equity market, why don't I want to be in cash?
Well, cash is really, really negative, right? If you look at the real effective funds rate or cash, you're losing 8%, right, per year. So in purchasing power. So you know, I still think.
But Jordan, Jordan, you just told me there could be further downside in the equity market as well. So well, if I'm losing on both counts if I'm in the equity market.
Well, you got to get two things right. You got to know when to get out and when to get back in, right? And so by sitting on cash, we can guarantee that you're going to be losing purchasing power. We don't know if there is the bottom, if we may, you know, sort of accelerate from here once the Fed sort of clarifies what policy will look like tomorrow. They may provide some forward guidance that the markets might actually like and rally on. And we don't want to miss out on some of those rallies banking on that by sitting in cash, we know we're going to be losing purchasing power.
So if that's the case, like, where do you hide out?
Well, I think you still want broad exposure, but you got to be selective. And this is really where active management comes into play. I think the easy money has been made. This is not a market in which a rising tide lifts all ships. You really want to be having high-quality companies that can deliver on cash flows, that have high degrees of operating leverage. So that suggests that sectors like energy, materials, financials that have that high degree of operating leverage. But you've also seen a lot of these growthier names sell off pretty meaningfully. And so now you're able to get some tech shares at a reasonable price, right? Technology sector stocks at a reasonable price. And so I think you create a little bit of balance and be really selective in this market.
Jordan, how do I know if they're a reasonable price if I don't know where the Fed ultimately is going to take the terminal rate?
I think that's fair, but I think we can feel confident that the Fed probably won't go to 5%, probably won't go to 6%. They probably end sort of just shy of 4%, I would say. And that's generally where the markets are sort of coalescing around. And so I think with that sort of backdrop, you don't really spell the concern for or full-out bear market in equities from here, right? It's not going to go down another 30%. But I do think you could see some additional price pressure. But as the clouds start to lift, particularly as we look ahead towards 2023 and 2024, then you may get that late year Santa Claus rally, if you will, and markets continue to bounce back to the first half of next year.
So I feel like literally a week ago, the conversation was, is 50 the new 25? Then it really quickly changed to, is 75 the new 50? And now I feel like the conversation will become, is 100 the new 75? In terms of what the market is now expecting on Wednesday, do you feel like if the Fed needs to shock the markets more, like, are we going to have to see 100? Like, are we going to have to see triple-digit rate increases? Like, what are you guys modeling for the risk of that?
The Fed has to be very, very careful here. Right now, the markets are pricing in 275, so 75 tomorrow, 75 in July, followed by 250s in September and November, roughly. So effectively getting the Fed funds rate to roughly 3.5% by the end of the year. But they're fighting inflation that they don't necessarily have the right tools to combat, right? It's energy inflation, it's food inflation. We actually saw core inflation supposedly, right? We're not sure, can't call it yet, but peak out in March of this year and has continued to sort of decelerate while headline continues to move higher. So they've got to be more careful and cautious, particularly after delivering and getting rates to roughly 2.5% by the middle of this year. They've got to be cautious in what they're going to signal to the market in terms of how much or how far they're willing to go to fight this inflation that should naturally dissipate over the back half of this year and into next year. And that's particularly within energy and food.